You are on the market looking to buy your first home. Aside from the offer price, what are any other things you need to consider to make your offer stand out, especially if you are competing with other people, which is often the case here in the Bay Area, California? The answer is contingency. Hi, I'm Ava, a local realtor here in San Jose, California. Welcome to my channel. In today's video, I'm going to give you an overview of contingencies, what they are, how you can use them as a buyer to your advantage, and when not to use them. To make it simple, you can consider contingencies as a right to cancel the purchase of a home. When you put an offer in here, you need to deposit 3% of the purchase price, which is a lot of money. Having a contingency is a way to protect the buyers to get the 3% deposit back. There are 3 common contingencies, and they are listed out on the purchase agreement. Buyers can include all the contingencies on the contract, and it's up to the sellers to accept or not. The first one is loan contingency, which means that the purchase is subject to your ability to get a loan from the bank. Most of us save up to the conventional 20% of the purchase price for down payment and borrow the other 80% from the bank by applying and getting a mortgage after your offer is accepted. The bank starts the underwriting process. However, sometimes the lender can decline your application for whatever reason, and now you don't have money to finish the purchase. Because you have a loan contingency on the purchase agreement, you are able to cancel the contract and get your 3% deposit back. All contingencies have negotiable time frames. The default time frame is 17 days on the purchase agreement, and you can put whatever days you want, shorter or longer. However, from seller's perspective, the shorter the merrier. They don't want you to hold their property up for, say, a 30 days loan contingency period. By the way, I'm just using this number to make a point here. Then the buyers cannot get the loan and have to back out in the deal. Now the sellers have to put the house back on the market, and they don't have the 3% deposit to compensate the loss of their time and opportunities. You can see why buyer contingency is not good for the sellers. It's very important to communicate with the bank beforehand to get their input and a commitment on how many days they need to get the loan approved. When I'm working on purchase offer for my buyer, I always make sure I talk to the loan officer to understand the timeline they need. This way, we can prepare a better offer to increase our opportunity. Let's say we offer the 17 days as the loan contingency period. Within this time frame, the bank approves the loan. Now, per the purchase agreement, the buyers need to remove the contingency and move forward with the purchase, assuming this is the only contingency buyers have here. The second contingency is the appraisal, meaning that this purchase is subject to the home to be appraised at the offer price. Once you are in contract, your agent will send the ratified purchase agreement to the bank, asking them to start the loan process. The first thing the bank needs to do is to have the property appraised. It's usually appraised by an independent third-party appraiser. From the bank's perspective, they need to make sure they are paying something at its value. Say you are in contract for $950,000 and the appraised value comes back at $900,000. The bank is still going to do the deal, but most likely they will only pay the $900,000. And then the buyers need to have extra $50,000 here to make up the difference. It's hard enough to save up the 15%, 20% down payment, and a lot of times buyers don't have extra cash to cover the difference. So this contingency gives the buyers a way out in case the property does not appraise. With this contingency in place, buyers have the options either to accept the difference and come up with extra cash, or they can try to negotiate with the sellers to reduce the price, or they can walk away. The default date is also 17 days, but also negotiable. The third is your physical investigations and the inspections of the property. It can also be in the neighborhood, in the areas nearby, in the permitting process within the local government, or something that you are concerned, like roof, the plumbing, the foundation, the examination of HOA documents. All these types of things come under the inspection umbrella. Most of the time, the sellers have done the home inspections and provided the reports as part of the disclosure process. In many cases, these reports are very thorough and comprehensive. If you still want to get your own home inspector and all contractors to look at the property and get your own reports, you can include that contingency on the contract, and you need to pay for that inspections. Again, the default contingency period is 17 days, but negotiable. If you are satisfied with the inspection, you will remove the contingency and move forward. Sometimes buyers use whatever they find and ask the sellers either to make some repairs or give credit back. Or some buyers decide to walk away. Having this contingency, the buyer is protected to keep their 3% deposit. Once you are cleared from your bank to close the loan, satisfied with appraisal and inspection, it's time to sign a contingency remove form. This is what the form looks like. You can see there are individual contingencies. There is one for your loan, one for your appraisal, and there is another one for buyer's investigation contingency. And that's broken down into several different options. Once you sign this, you are 100% committed to the seller, and you will not get your deposit back. In case you change your mind, when you remove your contingency, you are giving up the right to cancel that transaction. Make sure you are 100% comfortable with the decision. Please note this contingency removal is part of every single home purchase contract. I want you to have a clear understanding of what you are doing here when you sign this particular form to remove the contingencies. And at the bottom, number 4, where you can see buyer hereby removes any and all contingencies. That means we are fully committed on moving forward with the purchase. Now we know why contingencies are good for the buyers. Let's talk about when not to use them. In the Bay Area's offers can be very competitive. They often come in super clean, meaning no contingencies. There are still multiple offers with no contingencies for some nice homes in good locations. When we review offers as listing agents for the sellers, often we have scenarios like there are 2 offers very similar in price, one with contingency, one without. Most of the time, we would advise the sellers to accept the one offer without contingencies. Even sometimes the contingent offer has a slightly higher offer price because the contingent offer can back out in the deal pretty much anytime. That transaction is not as secure as the non-contingent offer for my sellers. So if you are competing with a few other buyers for a very popular home, you may need to consider waiving the contingencies, especially you are not coming with an aggressive high offer price. The non-contingent offer may give you that extra edge to win a house. But again, time you are all in, your non-contingent offer is putting your 3% deposit on the line. Make sure you really want a house and an offer price is at market value. Most likely it will appraise or close enough and your finance is strong. You get some extra cash if you need to cover the appraisal gaps. I hope you find today's video helpful. If you have any questions, comments regarding the home buying process, such as contingencies, please feel free to reach out. Thanks for watching. I will see you next week.